Welcome investors, and today we're analyzing Howard Marks' latest memo on Bubble Watch. This isn't just another market commentary, this is from the investor who correctly called the dot-com bubble 25 years ago in his famous bubble.com memo. Let's start with the current market situation. As you know, the 7 top stocks in the S&P 500, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla now represent 32-33% of the index total capitalization. This percentage is double what it was 5 years ago. For perspective, before these magnificent 7, the highest share for the top 7 stocks in 28 years was only 22% in 2000, at the height of the tech bubble. Marx explains that a bubble isn't just about rapid price rises. It's about psychology. Here's his exact definition. A bubble is a temporary mania characterized by highly irrational exuberance, outright adoration of the subject companies, massive fear of being left behind, and the conviction that there is no price too high. Let's examine Mark's experience with the Nifty 50 bubble in 1969. These were the best and fastest growing companies in America. Investors believed nothing bad could happen to them. The result? If you bought these stocks when Marx started work and held them for 5 years, you lost over 90% of your money in what were considered the best companies in the entire America. From this experience, Marx developed core principles. Here they are in his words. It's not what you buy, it's what you pay that counts. Good investing doesn't come from buying good things, but from buying things well. There is no asset so good that it can become overpriced, and thus dangerous. Marx introduces the 3 stages of bull markets. First, after a crash when few can imagine improvement. Second, when most people accept improvement is taking place. Third, when everyone concludes things can only get better, forever, for sure. Let's look at market persistence. Of the top 20 S&P 500 companies in 2000, only 6 remain in the top 20 today. Even more telling of today's magnificent 7, only Microsoft was in the top 20 24 years ago. Here are some companies that were leaders in 2000 but aren't anymore. Cisco, Intel, IBM, Oracle, and many others. The S&P 500's recent performance deserves attention. It rose 26% in 2023 and 25% in 2024, the best 2 years stretched since 1997-1998. Historically, there were only 4 other times when the index returned 20% or more for 2 years straight. In 3 of those 4 cases, the index declined in the following 2 years. Marx points to specific warning signs in today's market. The optimism prevailing since late 2022. Above average S&P 500 valuations. Enthusiasm for AI spreading to other tech sectors. The assumption that top companies will maintain their success. Automated buying by index investors regardless of value. Bitcoin's 465 rise in 2 years. He shares a crucial data point. When people bought S&P 500 PE ratios similar to today's multiple of 22, they always earned 10-year returns between plus 2% and minus 2%. Leading banks are now projecting similar low returns for the next decade. However, Marx provides counter-arguments. The PE ratio of the S&P 500 is high, but not extreme. The Magnificent 7 are exceptional companies, for sure. People aren't saying there is no price too high. Markets are expensive, but not completely irrational nowadays. Here's a powerful historical lesson from Marx. When stocks rise too fast, out of proportion to the growth in underlying companies' earnings, they are unlikely to keep appreciating. He attributes this wisdom to Warren Buffett. When investors forget that corporate profits grow about 10%, 7% per year, they tend to get into trouble. Remember Mark's warning. In bubbles, investors treat the leading companies and pay for their stocks, as though the firms are sure to remain leaders for decades. Some do and some don't, but change seems to be the rule that persistence. One final quote that encapsulates everything. The riskiest thing in the world is belief that there is no risk. For investors today, this means watch valuations carefully. Second, don't assume today's leaders will dominate forever, like Nvidia did. Remember market history, especially after strong 2-year periods. 4, consider that high prices today likely mean lower returns tomorrow. That's my analysis of Howard Marks' latest market insights. And remember, he's not definitely calling a bubble. He's giving us the tools to think clearly about the market risks. And you can see my results as the portfolio manager here, because I don't buy Magnificent 7 at all. There is no room and space for their huge growth. It's not for me. Thanks for watching, and remember to subscribe and more market analysis if you're interested in good returns. Thank you.